I'm Barry Nelson from Advent Capital Management. We manage three closed-end funds for Guggenheim. The crossover base has implications that are completely dynamic. It's an obvious opportunity for funds that are supposed to be equity funds, or maybe they're supposed to be fixed income funds, to obtain the advantages of convertibles. From a convertible manager's perspective, it's an additional source of liquidity to have buyers from other asset class sectors, indeed from bigger sectors, who are going to put their liquidity into our convertible market. It also may help that these buyers are sometimes a little bit slow on the uptake, that their focus isn't on convertible securities, and sometimes we can see them coming when something has happened that has caused a convertible bond to sell for less than it's worth. We can anticipate that these other buyers are going to come in once they become aware of this opportunity. There's no doubt that convertible securities are safer than equities. The idea that you have a bond that has to pay its interest and that matures and gives you back par value short of the issuing company going bankrupt this is a big source of security, and it's something that anybody can see. If something goes wrong with the market and the stocks go down and convertible bonds are available at discounts, if a convertible is trading at 90 or 80 cents on the dollar, you can look forward 2, 3, 5 years to maturity and figure out how much interest you're going to earn and how eventually you're going to get paid off at 100 cents on the dollar. This is a lot easier to foresee. It's a lot more comfortable emotionally than looking at a stock that's gone down, which could keep going down. The value of the stock is inherently less defined than the value of a bond. Convertibles are niche. The convertible market globally right now is over $400 billion. That, combined with the crossover investors in our market, provides a lot of liquidity. And yet, by global standards, $400 billion isn't much. Convertibles are difficult to be used by some extremely large asset pools. Moreover, convertibles seem to be complicated. Indeed, in our current technological era, with all kinds of we have algorithms evaluating everything, looking at the way a convertible can be evaluated quantitatively, for somebody who doesn't know about convertibles, they're likely to say, next case, give me something simpler than this. And yet they work. And perhaps one reason that convertibles do provide equity-like returns with less downside and with lower volatility is that it is a niche, and the opportunities in convertibles seem to never be arbitraged away. And when I say never, the confusion goes way back. At Advent, we've traced convertibles back to the 1830s. There was an incident on Wall Street in which a short seller who was hated by people who were chronic longs, he was short Erie Railway shares. And they tried to kill him by accumulating Erie shares and driving the shares up. And this guy is going to be bankrupted with his short position in Erie shares. This is in the 1830s. He had a hedge, an Erie convertible bond that happened to be traded in London, and these sophisticated market players on Wall Street in New York didn't know about the bond. So when they drove up his shares, it drove up his convertible bond, and he didn't get wiped out. This still works today. Ignorance is our friend. Being in a niche like convertibles is advantageous. It's difficult to index convertibles. Bonds don't trade every moment like stocks do. Humans trading convertibles may be one of the last situations in which humans will not be replaced by computers, by algorithms, and this sort of situation is highly advantageous to professionals who focus on the niche, who focus on the convertibles.